Welcome to Are You Investing Comfortably in partnership with Alliance Witten. I'm Georgie Frost, and I've been a financial broadcaster for over a decade. And if there's one thing I've learned, it's that investing often sounds far more complicated and intimidating than it actually needs to be. Investing isn't about being clever. You don't need to be an expert to do it well. It's about being consistent. And it's about understanding the basics, thinking long term, and putting a steady plan into place. In this first episode, we're going back to basics. What is investing really? Why does it matter? And how can you start without feeling overwhelmed by choice? Well, joining me to guide us through is award-winning investment journalist Cherry Reynard. Cherry, welcome. Thank you so much for joining us.
Nice to be here.
Cherry, what actually is investing?
Well, it feels like a big question, but actually it's quite straightforward. I think everyone's quite familiar with the concept of saving. So you put your money in a bank account, you get 3 or 4% interest, and all being well, you get your money back at the end. Great. But really, if you're investing for a house or a car or retirement or any other kind of expensive thing, it's going to take you an awfully long time to get there by doing that. So with investing, it's about putting money to work with the hope of achieving a higher return. So it might be putting money to work in the stock market or in bonds or in property. And your capital may be at risk, but the hope is that that will have a payoff further down the line.
You spoke there about if you're trying to save for something long term, maybe that's a retirement. When we're talking long term, what do we actually mean here? What sort of should your time horizon be, ideally?
The idea, I think, is that stock markets can be very volatile in the short term. But over the long term, they tend to deliver a higher return than cash. So usually advisors would kind of look at maybe 5 years, I would say, as a reasonably comfortable time where you could ride out sort of major volatility in stock markets. I mean, what you're really trying to avoid is needing your money at a sort of a moment when the markets are having a wobble, and then you have to sort of take it out and realize a loss. Whereas if you've just got time, you can just wait until they hopefully recover.
You mentioned earlier different types of investments out there. I think we're quite familiar with property, but just explain to us in more detail stocks and bonds. Stocks first.
Okay, so stocks also, so stock markets or shares or equities, to use the jargon.
Which in itself is quite confusing, isn't it? It's the
Yes.
same thing, isn't it? Stocks,
Yes.
shares, equities.
Yes, all exactly the same thing. And I mean, actually calling them shares is probably the best option, because that's really what they are. They are a share in a company. So investors pay their sum and they get a little, 1/10,000th or whatever of a company. And for that share, they are entitled to some of the profits of that company, which may be paid out as dividends. And then they are also actually, which people talk about less, but they also have a little stake in the running of that company. So, if they want to go to an AGM and make a fuss, then they can do that. They also, the hope is that they will invest in a good company and the share price will grow over time, and then they can sell those shares for more than they bought them for. So I guess that's the principle with shares. Bonds are a slightly different beast. It sort of operates like a loan. So they a company will issue bonds to either to finance its operations or for large investment projects, and investors will buy those bonds, and what they receive is an interest payment over time. So if they're a 10-year bond, they'll receive a set interest payment over time, and then they get their money back at the end, all being well. And bonds can be issued by government, so UK government, US government, and they can also be issued by companies. And the interest rate that people pay is set by how risky people perceive that entity to be. So, if a company's got a lot of debt, if its profits are falling, you'll get a higher rate of interest for lending to that company. If it's a high quality blue chip, it'll be lower. So that's bonds in a nutshell.
Just listening to you talking there, and when we were trying to define, stocks, shares, equities being the same, also the interest payment on a bond is called a coupon.
Oh, yes.
The language in investing is sometimes quite confusing, and we've done lots of work at this at Alliance Witten on the Learning Zone, so go and see that. But it is not helpful, is it, the language of investing?
No, sometimes I think, parts of the industry have a kind of a vested interest in making it complex, when actually the basic sort of building blocks of investing are really quite straightforward. And I think for people looking at, starting out in investing, it's quite difficult to sort of ignore all that complexity, but you can and you should, because there are really straightforward ways to invest. You could really just get a nice collective fund where a fund manager is doing the hard work for you, and you wouldn't have to think about it. You don't need to get involved in, the oil price is going up or the economy's tanking or any of that kind of that kind of thought.
I think of it like driving a car. I have absolutely no idea how a car works. A
Yeah.
bit like using my mobile phone. But if I want to, I can get very deep in learning how a car works. But I'm quite happy just driving my car. And you can take both views if you like. You can start just driving the car and then you can get much more involved if you want. But the key, I think, is just to get started. But for anyone who's still sort of on the fence thinking, if I can get a decent rate on my savings accounts, why would I take the risk and invest?
I'd highlight two elements. I mean, the first is growth. Stock markets over time have historically delivered higher growth than cash savings, and that can be really important. That can really make a difference to your long-term wealth. The effects of compounding over time are profound. So growth would be one. I guess the other one is inflation. If you have a savings account, you've got 3 to 4% UK inflation.
If you're lucky as
well. If you're lucky, yes. UK inflation is currently running at 3%. So you're getting 1% in real terms. And there have been times when actually you're getting less than inflation. Actually, until quite recently, that when interest rates were very low, that was quite a persistent problem. So that means your savings are losing money in real terms all the time. I mean, that's bad. So by investing in companies, in shares, if you think about a company, when it's faced with an inflationary environment, it can put its prices up. So actually, it should be able to sort of sustain its profitability. And that's reflected in share prices. So historically, the stock market has offered some protection against inflation. That might not matter over a year or two. But if you're saving for the long term, if you're saving for 20 years, that's really, really important. Inflation can be incredibly corrosive on your returns.
You mentioned a word in that we hear a lot in investing. It's compound and compounding. Einstein was credited as calling it the eighth wonder of the world. Whether he said that or not, I'm not sure. But I do love the phrase, he who understands it earns it. He who doesn't pays it. Just explain to us exactly what compounding is.
Well, it's really, I mean, we're going back to sort of high school maths. Let me illustrate it with numbers. So year one, you have £10,000. If that grows at 5%, by the end of year one, you have £10,500. Great. But then the next year, assuming you get 5% again, it's paid on the 10,500 sum. And that really sort of snowballs over time. And, I'd agree with Einstein. It's kind of like magic. It's an illustration of how much this can matter over time. So if you had £10,000 invested at 1% over 20 years, at the end of it, you'd have about £12,000. If it was 5%, it would be about £27,000. So it can really make a difference over time.
That snowball analogy, I think, is a fantastic one. One thing that we think about a lot when a snowball is it does get bigger as it goes down the hill, but it also gets faster. And that's the thing we miss. And once you start over a couple of years and then 5 years and then 10 years, you really start to notice that effect, don't you?
Yeah, and I think actually that it can work so well if you start young. You can do so much of that. I think part of the problem is that people think of investing as something that they'll do a little bit later,
when I've got some money.
When I've got some money, when I'm a bit older. But actually, if you could do it in your 20s, that snowball effect is so incredible, really, because your money's growing for like 30, 40 years. And you can really save yourself a whole load of headaches in your 50s if you start really young.
But I also think it's a really important message, because a lot of people listening or watching this will be older than 20. It's something we hear a lot, don't we? Oh, start in your 20s and you think, I wish.
I've got student loans, I've got rent. Yeah.
Well, or I'm 40 or I'm 50. But actually, we're working longer, we're living longer. You could, if you start at 50, easily have 20 years if you wanted to, or 40, 20 years. So I think it's a really important message to say, actually, it's not too late if you haven't started in your 20s.
Yeah, it's always working for you. Yes. So, yeah.
Talking about myths, I hear a lot as a financial broadcaster. I'm sure you do as as an investment journalist. But one of the main myths is investing just isn't for people like me. We said there, I'm not the right age, or I don't have the right money, or I don't look the right way.
Yeah.
It's not true though, is it? Investing can be for everyone.
Yeah, and I would say actually that you're probably invested already without realising it. So if you have a workplace pension, for example, that will be invested partly or wholly in the stock market. So you're there already. But really, it is for everyone. I mean, you can invest with as little as £5. And, even if you're putting 5, 25, 50 pounds, it will make a difference over time. It will give you a nest egg, that if you can make that compounding work for you, it's a great thing over the long term.
It's like I alluded to at the start, consistency is key, getting into a habit of putting money in. Another thing I alluded to at the start was this idea that you don't have to be some mathematical genius or financial whiz to do investing.
No, I have an English degree. I am not a financial whiz. But you definitely don't need to be. I mean, there are, you can hand the hard decisions about where to invest to an expert. So you can say, roughly, this is the kind of risk parameters that I would like. These are the risk tolerances I have. And, they will do all the hard work for you. They'll do all the thinking for you. And you can just put £50, £100 aside every month into a global diversified investment fund. Very easy to do. And you don't have to think about it. If you get that core right, then you can go and experiment with your space travel ETF or whatever you fancy when you've got comfortable with it. But in the meantime, it will be very effective just doing £50, £100 a month in a simple, straightforward collective fund.
So for anyone who wants to get started investing, what tips would you have for them?
Definitely don't overcomplicate it. When I first started out, I was I really thought I was going to find the next Amazon and invested in a lot of very, very silly stuff when really I should have just put money as I said, in a nice collective investment fund. So I think what I'd say is use one of there's a lot of platforms to choose from, mostly the reputable platforms that you will have heard of. They're all good. Their technology is good. They will all have pathways on them to help you choose the right investment, to help, guide you based on your sort of risk and your aspirations for your money. So go on those. I would also say it's worth investing in an ISA wrapper because while over 1 or 2 years, the fact that you're paying sort of tax on your investments won't matter that much, but over the long term, that really can make a difference. And the tax situation can really interfere with that sort of compounding thing. So ISA wrappers, good. And then just keep paying your direct debit. I remember advisors always saying, make sure it comes out, the moment your salary goes in, so you never miss it. Perhaps ratchet it up a little bit every time you get a pay rise and forget about it.
All great tips. I think if I was to offer my own, I would say the first one is the most simple one. I think too many of us let perfect be the enemy of good. And I think just get started. Choose a reputable platform, just get started. It's like driving that car. You are not going to be perfect at the start. And then you can start to learn and do read about it. Listen to podcasts, get involved, and you'll get more interested with your investing, or not, as you choose. To that, I would also add, we're seeing many, many more people go online, particularly social media, to get their investing news and tips. There are some phenomenal people, companies that are giving great information on social media, but there are also a lot of bad actors. And there's also a lot of noise. So much noise. Everybody telling you what to try to tune out the noise. And also with that, I would say markets go up and down, particularly in the world it feels we're living at the moment. Try, if you can, not to obsess over your investments. It can be very tempting, especially if you've got a mobile app and you can see and things are moving from day to day. Do try and stay calm. And actually, if you are someone who will freak out if markets drop by a big amount, then maybe you're invested in the wrong places. So that is telling you something. But try, if you can, not to obsess, tune out the noise, and just get started.
Yeah, I think especially the monthly saving is really powerful for that, because it means that every time there's a blip in markets, you're investing at that lower price point. So it just sort of evens out that volatility all the time. It means you don't have to worry. But I would say, if you need reassurance, go and look at sort of long-term charts of, the S&P or the FTSE 100. It's very powerful. These blips, when you put them in context, they're pretty small, even though they feel very raw at the time. In the long term, they just even out.
So keep calm and carry on.
Keep calm and carry on, exactly.
Jerry, thank you so much. And thank you for joining us. I hope you're leaving this first episode feeling a little clearer and a little more confident about what investing actually is and how to begin. If you'd like to learn more, you'll find plenty of resources in the Learning Zone on the Alliance Witten website. Next time, we'll look at the psychology of investing and the behavioural biases that can shape the financial decisions that we make. Until then.